there's something we refer to internally as the transition risk paradox. And the paradox is that compared to flood risk, where we've got a clear view of how to stress test, thanks to CBES and NGFS scenarios that lead up to 2050, we don't have clear instructions of how to stress test a transition risk. In fact, we don't always know what that transition risk would look like. Regardless of government policy, we know that the Climate Change Committee have been clear that 89% of UK homes need to be A to C by 2035. And so we can use C as a minimum standard to model against that. By upgrading, updating the cost data we have access to, we can pull together a much more accurate view on how much it will cost each property in the UK to get to that sea level. And in doing so, that then gives us a clear data point which you can feed into two questions which amount to some standards stress testing. So question one, can the cost be absorbed into the current loan? So if you add that cost to C, the outstanding balance, does it fit within the original agreed LTV ratio? And if so, then arguably you can lend on the same terms, and that property itself is not high risk because it's affordable for that property to get towards C. Similarly, could you offset the cost of C against the value of the asset? We get asked by lenders to assess whether the cost of C is more or less than 5% of the value of the asset. And again, if it's less, you can argue it's lower risk because it is affordable to get there. So two questions to ask, can the cost be absorbed into the loan, and how affordable is the cost of retrofit versus the value of the asset, to allow you to stress test, to fill in this kind of gray area of how to stress test transition risk.